Hello, everyone. This is a podcast discussing our PowerPoint slides for earnings per share and stock-based compensation. We're looking at both the journal entries and how that affects the financial statements, and we're also looking at how that affects earnings per share calculations. So that's our two focuses in this explanation. So some definitions or some ideas with having to do with share-based compensation, which is the generic term for any time that employees are compensated with stock or some other equity form of compensation similar to stock. So one of the very common ways of doing that is with options. There are two types of options: incentive options and non-incentive options. The ones we will be worried about and doing the accounting for are incentive options. And what that means is that when an option is the right to buy a share of stock at a set price. An incentive option is one where the set price is either the same price as it is currently trading on this stock exchange or a higher price. So the incentive in this case is for the employee to work extra hard so that the stock price will go up above where it is now, and then your option to buy it at the set price now will actually be worth something. It's called in the money, meaning that it actually has intrinsic worth. These options have favorable tax treatment, so most companies want this to happen, meaning that you don't pay taxes on the full value of them, and you pay at lower capital gains rates, which is beyond the scope of this course, but is an important consideration. Non-incentive options is when the price that you can buy your stock at is lower than what everybody else can buy it for. So you get a compensation whether or not the company does well or not. So you have, they might say, no incentive. That has taxable income right away. It is not tax favored, and so therefore companies tend to avoid them. So we're going to be looking at incentive stock options, but you should be aware of the non-incentive part as well. Restricted stock has become much more popular as options have become less popular. Companies have issued restricted stock, which has less risk to the employees and therefore is favored by a lot of companies. Restricted stock is basically you give the employee stock. It's set aside, meaning they can't sell it. It's not vested. They own it in name only, meaning it's assigned to them, but they can't do anything with it until they have reached the vesting period, meaning that they have stayed employed or reached certain performance targets, that sort of thing, will vest those restricted shares. So our question when we talk about restricted shares is it vested or not? And we'll see why that's important a little later. And then the third one that we want to make sure we understand is stock appreciation rights. This is actually a bonus where the company pays the employee based on the difference between what the share price is at a certain time and what it was when they set up the agreement. So I tell you that the stock price right now is $10 a share. If it goes to 15, I will pay you in cash the $5 difference in share price times however many shares, stock appreciation rights I choose to offer you as some kind of a bonus. So in this case, we actually have cash, and so we're going to actually have a liability. This is not going to affect stockholders' equity. It is simply a compensation form, a way of calculating compensation that would generate a liability, not owner's equity. So how do you record compensation expense? First of all, some principles. All share-based compensation is measured at fair value on the grant date. So whether you're looking at options, whether you're looking at restricted shares, they are measured at fair value at the grant date at one time. So usually you're not going to have an entry on the grant date for especially incentive stock options, because all you've done is agreed to do something. Nothing has actually changed hands yet. None of it is earned. None of it is vested under a restricted stock. Sometimes restricted stock at the beginning of the agreement, there is a journal entry, but it's very, you might say, kind of not important in the sense that all it does is debit unearned compensation, which is part of equity, and credit to common stock is part of equity. So nothing in equity changes on the date of grant or when the agreement starts. Now, if there is a performance-based calculation, meaning I tell you you get 10,000 options if our net income is a certain number, and 20,000 options if it is a higher number, that type of performance-based agreement is recorded at the most likely outcome. So how I look at what I think the net income will be for the term of the agreement, and then I calculate the compensation expense using the options or restricted stock based on that most likely outcome. Then once we have determined our total compensation expense, we recognize it as expense over the vesting or service period, and may have to adjust it based on forfeitures and so forth, but typically over time. So if it's going to be earned over the next 5 years, we're going to record 1/5 every year for the life of the agreement. You're going to record compensation expense with a debit, and either credit additional paid-in capital if they're going to, sometimes you'll see that additional paid-in capital stock options, but main thing is that we record additional paid-in capital. Or if it's a stock appreciation right and they're going to get cash, then you're going to credit a liability, how much is owed. An example, okay, we grant 100,000 options employees on January 1st, which they can exercise buy shares at 15 if they're still employed in 5 years. We'll assume it's an incentive option, meaning that the price anybody else can buy it is also $15. Fair value is estimated at the grant date. Okay, the value is $5. We're not going to worry too much about the process of estimating that fair value. That's a very involved process. But the point is the fair value, not the exercise price, is what we use. So we're going to use the $5 times 100,000 shares, or 100,000 options in this case. The unearned compensation will be 500,000, which most of the time is not recorded at the beginning, but only over time. Assuming that is most likely that all will be vested, meaning you consider who might leave your company and how many that will be in estimating that. Compensation will be recorded at $100,000 per year for the next 5 years, adjusted for any change based on the most likely scenario, as if there anything changes in how many people have left the company or that sort of thing. We're going to debit expense and credit additional paid-in capital. So if everything goes exactly as planned, you will debit expense and credit APIC each year for 5 years for $100,000. Simple versus complex. When calculating earnings per share, you're looking at two situations. Simple capital structure, you have what's called no dilutive securities. Nothing that's going to add to the number of shares outstanding that are going to be likely to convert it into common stock. So simple capital structure means that you have nothing that's could end up with more shares being issued. So a stock option is something that could end up with stock being issued. A convertible bond is something that could end up with stock being issued. Those are what's called dilutive securities. Anything that could automatically or based on the option of the owner turning into common stock is a dilutive security, or potentially a dilutive security. A complex capital structure does have dilutive securities, so that's the difference. Complex has it, simple does not. The three that we will worry about are convertible preferred stock. That's preferred stock that can be converted into common stock, therefore there'll be more shares outstanding. Convertible debt, bonds, or some type of loan that can, instead of being paid off in cash, could be paid off in stock. Options or warrants, we'll use those terms kind of interchangeably. There's a slight difference in the legal definition, but they work the same as far as from an accounting standpoint. Or restricted stock units or restricted stock. Those are also, because when the stock is restricted, we don't count it until it is vested in terms of how many shares are outstanding, but they could become vested at any time. So here's the underlying principle of this idea. Basic earnings per share is the simple capital structure. You basically have the shares outstanding and that's it. A complex or with dilutive securities, the potential is that you could have more shareholders jumping on board. You could have your bondholders becoming shareholders. You could have your preferred stockholders becoming common stockholders. You could have option owners becoming shareholders, all of which would make the people that own stock already have a smaller piece of the pie. That's what we're worried about, is measuring just what the effect would be on the existing shareholders based on these other potential shareholders. So you might say the complex capital structure situation, we're going to pretend that all these potential shareholders become real shareholders. So when calculating these, you always start with basic earnings per share. So the first step in any calculation of earnings per share is to take net income or income from continuing operations, subtract out preferred dividends, only preferred dividends, not common dividends, preferred dividends, only those paid to preferred stockholders, and then divide it by the weighted average shares outstanding. You're going to include preferred dividends that are paid and those that are declared even if they're not paid. So all preferred dividends. You're going to calculate this weighted average. That's just a math calculation, but it's a little tricky. You're going to take the number of shares outstanding times a portion of the year outstanding. So if there were 100,000 shares outstanding for half of the year, you'd take 100,000 times 6/12, because we're doing everything by months. And that's how you would calculate the weighted average. And then you would change and do the new number of shares outstanding by the number of months. Technically, according to GAAP, it should be done on a daily basis, but we're going to do everything on a monthly basis because our life is going to be much easier that way. Some principles to remember. Converted securities are counted as the date of conversion. So if we convert preferred stock into common stock, that starts on the day of conversion. So if calculating our weighted average, those would be outstanding for the rest of the year, the part of the year that they are outstanding. Stock splits and stock dividends, however, are treated as if they happen on the very first day of whatever time period you are looking at. So if you're calculating it on a quarterly basis, it's as if it happened at the beginning of the quarter. If you're doing it on an annual basis, you're going to treat it as if it happened on the beginning of the year. Restricted stock that is vested is included in your basic earnings per share. Those are real shares. Once they're vested, they are just regular shares like anything else. And then the last thing to remember is if you have a loss, not net income, but a net loss, you don't need to calculate your fully diluted. You only need to calculate basic earnings loss per share in this case, because the dilution will actually make things look better, not worse. And we always want to look at the worst case scenario.